Hello again. This is Andy Barkate, publisher of the Think to Retire newsletter and AIA, Adaptive Asset Allocation. Now, before we start our webinar, this is the webinar, our month-end webinar for February 2021. While some extra people are kind of coming into the meeting room, I recognize some of the same names I see, and I see some new names out there too, so welcome. Let me go ahead and share my screen and kind of get started. These things usually last about, 15 to 20 minutes, give or take a minute or two. So let's see if I can get my screen share started and get this thing going in the right direction so it all looks good. Come on. There we go. Okay. You see me up in the right-hand corner from now on. So again, this is our webinar for the 26th of February. And again, just to kind of take you through what has happened, why we're doing what we're doing, and then again, kind of explain some of the methodology that makes the Think to Retire newsletter and AIA what it is. Okay. Now, before I get started, I do this every time. I don't really answer questions during the webinar, but I want communication between us. The whole idea of these webinars is to get information out to you. And I realize I want to keep the seminar to the webinar to a finite period of time to respect your time, but I do want your questions. You can call me. There's my phone number. You can write it down. This slide will be at the end of the webinar as well. There's my direct email to Think to Retire. You can go to the website, thinktoretire.com, and request a demo, request a live phone call. A lot of cases, those will be with me. And again, these webinars will be archived on the website behind the password protected side. So just the subscribers, all of you folks, can go back and you can view this again. This will be back up probably in a day or so, and you can look at some of the past webinars as well. Okay, let's get started. All right, from beginning of February to now, today, the S&P is up maybe just about 0.63 because we've kind of bounced around. Now this goes back a couple of years, but this is kind of the last month right in here. This dip you see is because interest rates have been going up, and I'm sure that has not gone unnoticed by most of you folks out there. The Treasury bill you see is 1.46. It started the month probably right about 1%. So it's jumped up close to 0.5%, which is a big move in bond land, and that's created a lot of volatility out there and got some people worried about inflation. Okay, some of the things that are driving the market, we always like to talk about these, and these have kind of been in the headlines. It hasn't been a lot of change there. The big change is just higher interest rates. That's kind of come up and scared people, made them a bit nervous. Is all this government money, this 1.9 trillion COVID package, going to throw enough money out there to rekindle inflation? And is the vaccines that are going into people's arms now and reopening the economy going to speed the economy up enough again to rekindle inflation, hence higher interest rates? Jury's still out on that, but the market's a bit worried about it. We have prices of oil actually creeping back up. A lot of folks around here in Kern County, where I live, in Bakersfield, like that. We don't like paying a lot for the pump, at the pump, I should say, but we know that it helps the economy as well. So it's something we stomach, I guess, paying a little higher at the pump because we know it helps a lot of people. And we've got some probably, with the Biden administration, probably some higher taxes coming probably the second half of the year, at least the legislation perhaps coming down the road. Don't know what's going to happen, but it seems to be a foregone conclusion. We're going to see something at least try to be enacted into legislation. Okay, let's take a look and see where we're at now in February. Here's our sectors: technology, basic materials, consumer non-cyclicals, and industrials. Right now, the AIA strategy in these areas is up 0.6. The market's up a little bit more year to date, 2.1. And again, what's hurt us a little bit this month as rates have gone up is technology has got slapped around a little bit. As rates tend to go up, technology companies are viewed to have a harder time borrowing money to expand. Hence, it hurts their growth long term. That's the line of thinking anyway. And some of the technologies have bounced around, and that has hurt us a little bit with the return. So don't know what's going to happen, but again, it looks like it's going to make it through at least to the next month, but probably, and I always show this and I say probably we're going to see some changes. More than likely, energy is going to replace basic materials at the end of the month, which is a few days from now. The middle of next week, we'll get another newsletter with the new 4 allocations, the new 4 sectors. Be aware this might be a change. It's not in stone yet. I'm just kind of giving you a heads up. So be ready and keep watching your inboxes for the new newsletter. Okay, Now, this is kind of a repeat. So those of you that have heard this before, you can either drop off the webinar if you want, or I'd love to have you stay on, because this kind of goes, this is the part of the webinar where I go through the rationale and the methodology of Think to Retire and AIA, Adaptive Investment Allocation. It's good for folks to hear every once in a while. It's good for you new subscribers to hear this, because the more you hear it, the more you understand what we're trying to do and how to best use this newsletter to implement into your financial life. Okay, the newsletter itself is pretty much an investment newsletter, but it's got definitely a retirement and a financial bend to it. We're going to send you weekly updates, weekly market updates on what happened the last week. It comes on Monday morning, right in your inbox. So if you're not getting them, call us. We probably have a bad email for you, so make sure we do that. You get the monthly webinars, which you're listening to right now. And the newsletter, of course, comes out the first business day or the first trading day of every month. We will also throw other bits of information in there every month in the newsletter that we deem worthy from a financial point of view. It could be about taxes, Social Security, Medicare, estate planning, just things that you should be aware of. So when you can make decisions, you know you're up to speed on what's happening out there and how it might affect you. Okay, now let's spend the rest of the time talking about AIA, Adaptive Investment Allocation. It's really sector rotation with risk control, risk management built over the top of it. Now, there's demos on this on the website, which you can actually look at whenever you wish. I'll probably go a little bit more in depth on those webinars than I am now. And again, if you want to just talk to somebody here, it probably will be me, and just ask questions as long as you want to about AIA and how it works, so you get a better feel for it. Go on the website and just request a demo, and you'll find a good time to do it. It works in my schedule, and we'll sit and talk for a while. Okay. Afterwards. Now, I had this slide on here every time. I think it's important because this really explains the thought process and the theory that we have at Think to Retire about why we're doing what we're doing. Benjamin Graham, the famous instructor, famous professor, wrote several books that are still in use today as far as investment research and investment allocation. He taught at Princeton. His most famous pupil, as I say all the time, was Warren Buffett. And he said a lot of things, and this is one of them. The essence of investment management is the management of risk, not the management of return. And that's a lot of what our philosophy here is at Think to Retire. And that's what AIA is built around. We're trying to control the volatility. We want to basically capture most of the gains in the good years, and we want to hopefully avoid most of the losses in the bad years. And by using sector rotation as well as risk management, which I'll kind of go through that in a second, that is what we try to do, and we'll show you some of the results. Okay. Markets have personalities, and that's why sector rotation, I think, is so important. What the market likes today, it may not like tomorrow because of a lot of different reasons. Things change in the economy, things change in Washington, things change around the world, and that affects what sectors of the market, what industries that the market favors or disfavors. So what we're trying to do here with AIA is constantly keep the top performing or the highest relative strength sectors in front of you every single month, and in that they will rotate from time to time. Sometimes, and I'll go through this in a minute, every time we change, there may be a wholesale change. It may change out form, put 4 new in. Some cases, there's no change at all. They're all holdovers. What was strong last month continues to be strong. And sometimes there's a couple of changes. So you have to just watch your emails and make those updates. And the markets do have definable patterns, and we're trying to capture those by doing the sector rotation and try to keep you in areas that look strong and away from areas that tend to be out of favor. And then by and large, try to keep you out of trouble. That's the risk management indicators goals. Okay. Now, basically how to use it. First of all, we're not trying to give you direct individual investment advice. Everybody's getting the same information. You can use it differently, but nonetheless, we're all getting the same information at the same exact time. You can go to your brokerage accounts and into the transactions, move out of the sectors, move into the new sectors. I think it's important to have a good relationship with the firm you're using. There's many good ones out there. I think you want a good, easy to use platform, one that's easy and has very good online capability. having commission-free trades is definitely a win, because again, that's just more money in your pocket. And I think it's also nice to have good phone support. I always say this because every now and then something's going to happen where things just don't look right. You have a question about entering a transaction, and you just want to make sure you're doing it the right way. And being able to pick up the phone and hopefully have somebody you can talk to 24/7. If you're actually looking at things on Sunday afternoon at 2 o'clock, well, you may want to talk to somebody then. And a lot of these companies have that 24/7 phone support. So that's something to kind of think about. Again, we don't put in your transactions for you. We don't understand, or actually we don't have anything to do with where your money is held. And we have no idea how big your account is. So we're just trying to supply you the information that you can use yourself to make your life better from a financial point of view, and constantly keep you updated and give you something very quick and easy to use. You know, our newsletters really, I mean, you can read a lot about it. The website's pretty in depth, but the newsletter itself is pretty much one page. You'll see what the risk indicators look like right on the top of the page. And as you go down, you'll see the allocations, the new allocations. You'll see the older allocation from the past month, just so you can draw some conclusions. And you'll see what you're moving away from and moving into. And you simply just look at that newsletter, go right to your brokerage account, probably have it open in another browser, enter the transactions. You're probably in and out in 10 or 12 minutes. Okay. I say this a lot, and I truly believe it, that you need, I think everybody needs some sort of system, something that's rules-based, something that's math-based, to kind of keep them in focus, keep them from making mistakes, keep them from being too emotional. And I think most people, or most investors that don't do well, it's not because they're not intelligent enough. It's not because they don't want to or spend the time. It's just in some cases they start doing things very random, and it's hard not to get emotional when your money's involved. We all have that problem. So Think to Retire can provide you that system to actually keep you from becoming too emotional and probably making mistakes that'll cost you money down the road. It gives you that system that's rules-based and is always doing the same thing, so you have more consistency in your investment management. Okay. During positive market environments, when our risk indicators are indicating the market direction is positive, you'll be in four industry sectors. Here are the 11, 12 sectors we use. You'll be in the top 4 performing sectors based on their relative strength. Now, it's important to understand that if the market's in a very strong uptrend, all these sectors may be going up, but we want to basically be in the ones that are actually more in favor and increasing faster, and kind of stay away from the ones that are lagging. Now, if we have a negative market environment, if one of the risk indicators trigger and it shows we may be going into a downtrend or continuing a downtrend, we'll issue you an alert and tell you to back out of the market and go back into some sort of bond, maybe bond fund, bond ETF, or maybe even just into cash to stay out of risk. We're trying to avoid most of that downside. Okay. Let's talk about the indicators for a second. There's 2 of them. There's T2R, Think to Retire 1, Think to Retire 2. 1 is long-term and 2 is short-term, kind of the canary in the coal mine. Now, it's important to know that both of these indicators have to be positive for us to be in the market and in those 4 industry sectors. If either one of them turn negative, we're going to send you an alert immediately, and you can back out of the market and go sit in bonds or cash. We want to avoid most of that downside. And again, there's an indicator, there's a webinar in the website that talks about the risk indicators in more depth, if you'd like to listen to that again. Or again, you can call me on the phone. We'll set up a time to talk and we'll go through them. Okay. What these risk indicators are really doing is crunching data. They do it every single day. They're looking at things like advancing decline lines. They're looking at maybe moving averages, several sets of moving averages, new highs, new lows, different issues. And they're trying to determine, at the end of the day, are more stocks being accumulated than distributed? Is there a stronger demand for stocks, or is there a weakening demand for stocks? And by looking at this data all the time, they can glean that information out of it. And really what we're trying to do, we're not trying to time the market at all. This is not what this is about at all. And it's not a perfect system, but it does a very good job historically. And what we're trying to do is, if we're in an uptrend and the market starts to fall, the data is being consistently analyzed, and this dip that we're currently seeing, the data has to prove that that new downtrend has a high probability of continuing. And if it does, you'll get an alert. we'll issue that alert. It'll come to your inbox and it'll tell you to move out of the market and go back to bonds. Now, in some cases, the market can fall and the risk indicators don't get triggered. It's again, it says the data hasn't justified that dip looks like it is going to continue. So we stay in. We've all seen that. We've seen the market have a bad day, a bad week, or maybe a bad 2 or 3 weeks, and all of a sudden it comes back up again. We're letting the data lead us to where we want to go. We're not trying to guess. We're not trying to project. And there's no emotions involved in this at all. It's all math. And on the other hand, if we're in a downtrend and the market starts to come back up a little bit, the same data is being analyzed. And if that data shows that this new uptrend looks like it has a high probability of continuing, same thing will happen. You'll be issued an alert, go back into the market. We'll give you the 4 new sectors to go in. You can go trade out of the bonds into cash and go back into them. Okay. It's important to know your risk. And I think most of you out there listening today, I'm sure you've done your risk analysis and you have an idea of how comfortable you feel as far as your risk tolerance. But I think it's good to go back and do it every now and then. And if you go to in the step 1 of the process, which is on the website, you can see the link to this risk tool, this risk questionnaire we have that you can use just to kind of give you an idea of what's happening, or how you feel about risk, so you know maybe better how to use AIA inside your account. Okay, and here I talk a little bit about that. Let's just make the assumption that you're of moderate risk. Let me go back a second. Let me see if I can go back. Okay, this is a risk analysis I did on me, and I answered the questions, and I'm pretty much average risk. So this AIA moderate is pretty much how I might allocate my money if I was moderately aggressive or moderately safe, if you want to talk about it that way. I may have about 60% of my money in AIA between the 4 sectors, and the other 40% of the money not in the stock market. Maybe it's in bonds, maybe it's in cash, maybe fixed accounts, but it's not in the stock market. I don't want to take that much risk anymore. That's when the market's positive. When our risk indicators are both positive and we're long the market, will be maybe 60-40 if you're moderate risk. I'm just giving you some ideas. You can do what you want, but again, I just want to kind of tell you some ways where you might use it. Now, if the risk indicators trip off in the market, it looks like the market's dipping, and that dip looks like it's going to continue, so the risk indicators kick off. We go back out of the market, you get away from the AIA and go back into bonds, hence you'd be all in bonds and cash. So, and you can use it a lot of different ways. I've talked to some subscribers where they don't ever want to be completely out of the stock market. So they may just unweight some of AIA and maybe keep 20-25% in AIA and move the rest to bonds and cash. That's okay. But again, it's just, I'm trying to give you some ideas how to use it so you can better understand how you can change things depending on your feelings. Okay. This is something maybe a bit more aggressive. Somebody that's maybe a bit younger, maybe more comfortable with the market and comfortable with risk. Maybe 80-90% of your money can be in AIA, where they're split between the sectors, and maybe a smaller amount in bonds or cash. You don't mind taking the risk. So when a positive market environment, we're very heavily invested. And if the market goes negative, we back away and again, go back into bonds, because it looks like, according to the risk indicators, that we've started a negative trend that might continue for a while. So why lose some of our past gains? We want to kind of sit it out if we can. These are some of the returns. Now, this goes back to the AIA moderate, where it was about 60-40, 60 in AIA, 40 in bonds all the time. And you kind of see the track record here. The blue line is the portfolio, the AIA moderate, going back from 2001 till into 2020. Now you see the returns look pretty strong. The average return is about 12.6, and the market for that period of time was up just a little less than 7. But I want to draw your attention not so much to the rate of return. That's great. That's the shiny thing on this screen. But I think the thing that's more important is the volatility control that the models and the allocations and the risk management give us. If you look down here at loss exposure, the loss exposure profile, you see the dark shaded areas. That's what the market showed as far as losses during different periods of time. And these smaller blue patches you see mixed in here, that's the volatility expressed by the model, much less volatility. Now, it's kind of hard to see it on this graph, but this is the S&P 500 with dividends. That dip we see right there is when that was the turn of the century, where we had the dot-com bust, 9/11, all that was built in there. And this big dip we see here is the mortgage meltdown, 2007, 8, and 9, that range. Now, it's hard to appreciate it, but that dip right here with the mortgage meltdown was about 55%, 55% loss to the S&P. The one here at the beginning of the century was about 42. So the graphs don't really do the justice of what really happened to the market. But again, you see at the same time, because the volatility controls were in place and it pulled us out of the market before much damage happened to us, we avoided the lion's share of those hits. And I always tell people, if we can avoid most of the downside, we don't have to shoot the lights out in the up years to have a pretty doggone good return over the long run. And that's what this is really doing for us. We're missing a lot of the downside. So again, in the up years, the returns take care of themselves. And if you look over here to the maximum drawdown, and what drawdown really means, it's kind of the point in time where the market took its biggest drop from peak to trough. And the model, its worst decline was just about 10%. And that was back in the middle of 2010, back in here, up here. And the S&P 500, during about the same time, towards the end of 2009, it was down about 55%. So again, about a 5-to-1 ratio of being a little bit safer. And just, again, we're trying to keep the lion's share of the gains, or capture most of the gains of the good years, the lion's share. And like we're showing here, try to avoid most of those losses in the bad year. In the end, and at the end of the day, we end up looking better and actually sleeping a lot better at night. Okay. This is the same graph, but with the growth model, where we have more money in the models in AIA models, more in the market, less in bonds. The lines look similar, but if you look at the rate of returns, it went up from about 12.6 to just shy of 14.2. The S&P was still up 7, so roughly double the return. And the risk profile went up a little bit. It went up from roughly 9.9 to a little over 12. So we took a little bit more risk, but we got a lot more gain out of it too. So you can look at it that way. And again, I always like to point this out. Yes, these numbers look great, and a lot of people get very excited about them, but they're not perfect. I mean, you can see there's dips in here. And these dips sometimes may be, like you say, 10%. This is not a market timing system. We're not trying to jump in at one day and out the other. We're letting the data tell us where to go, which is why when the market's bouncing around, good or bad, I don't worry about it that much, because I know the data is going to lead me in the right direction the vast majority of the time. Again, it's not perfect, but it does a great job over the long run. And I think some of these numbers and these graphs kind of bear that out. Okay, kind of the end of the webinar. I try to keep it relatively short. I already see on my screen there's been a handful of emails that have come in already. That's great. But again, here's the contact information to reach me, to ask questions, the phone number, the emails. You should all have this already. And again, I always recommend get demos, ask for phone calls, ask your questions. That's how you're going to learn to use this system to its utmost. And again, we'll be back with the next webinar. I'll put that date out here probably in a week or so. And again, I try to do them on the last Friday of the month, but sometimes it doesn't work well. I end up being out of town, or maybe it's a holiday. So we'll do it earlier in the week, but it's always going to probably be that last week of the month, just to kind of get you ready for what's happened and what might be going on in just a few days when the next newsletter comes out. So again, thanks for hanging out here for a while. And it's Friday, so enjoy the rest of the day. I hope you have something planned for the weekend. I do. But again, use the webinars, go back and look at them on the archives. And I always say it, and I say it too much sometimes, don't be bashful. We want communication with you. So call up, set up a demo, set up a call, and we'll sit down and chat for a while. Thanks a lot. Enjoy the rest of the day.